Hello again and welcome to part 3. Um, we're now going to cover the next section. We've covered part 2, quick recap. This section covers allowable expenses and we've got various figures in here, and at the end of it, it worked out that we had, I'm just waiting for this browser to catch up, of monthly total of 2,477 of allowable expenses, which equals 29,725 a year, that can be taken and placed against your property profits, providing obviously all these things are legitimate, and your accountant or tax advisor would normally double check all of this. So let's move on to part 3. We're now going to cover various sections, and the first thing I want to note is that at the moment you're a 0% taxpayer because there's no income placed in there. All that it's showing here is what everyone gets, which is a personal allowance. So we're going to see what your buy-to-let business, the effect that it has on this. So first thing we need to know is a few things to remember. One, always seek professional tax advice for confirmation of any of this. I'm not a tax professional, but I have been affected by Section 24, hence the fact I put this estimator together for anyone who wants it, really. So you can print it off, send it off to your accountant or whatever, and see if they can confirm any of your own circumstances. There are 3 critical calculations. We've already done one in your expenses, and we now need to do another 2. So the first thing we need to know is what is the value of your actual portfolio. So first of all, how many buy-to-let properties in your own name, not under the name of a limited company, do you own, either with yourself or your partner or whatever. So for this example, I'm going to pick 6. It actually goes up to 100, but I'm just going to pick 6. Okay, and the buy-to-let portfolio value, well, I'm from up north. Okay, so I'm not badly affected as you lucky people down south with your very expensive properties. So it's 476,000 for 6 properties around here, and your buy-to-let mortgages against that. Sorry, it was 676 for that, and it was 474. Now I've got these figures from my balance sheet that the accountant's prepared. If you haven't got a balance sheet, you're going to have to figure out how much from your mortgage statements you still owe the banks. Sorry, but that's the way it is. So going on these figures, I'm currently running my portfolio at 70% loan to value, which leaves potential equity in my portfolio of 202,000. So if you add 202 to that, it comes out at 676. So that's simple. So the boxes that you fill in are the yellow ones. So there's nothing difficult. It does all the adding up and taking away for you. Next thing, based on that, still nothing's changed. You're still 0% taxpayer at the moment. But let's assume you've got an income from elsewhere. So we'll just go to section C before we put the rental income in. And say you're a doctor or a nurse and you're in the NHS, or I don't know, you sell lollipops from a market stall or whatever, and each month you're earning, say, 2,000 quid, or make it 3,000 a month. So that's 36 grand a year, which now places you in the 20% tax bracket, does it not? Yeah, see, so pretty straightforward. So let's go back to the section that we missed. So we're earning 3,000 a month. Now we need to know your rental income in section B. So what are your buy-to-let rents each month? And by buy-to-let, I mean HMOs, residential properties, not holiday lets that are furnished, because they have a different tax regime. So we're going to stick to buy-to-let properties in your own name, not under the banner of a limited company. Okay, which in my case would be, see, 6 properties, call it 4,500 a month, which is 54,000 a year. This is your gross rents before any expenses taken off. And now we need to know how many months empty each year you've got. So for example, if you were a student accommodation landlord, you might have a property that's empty for 3 months during the summer break, in which case you select 3 here, and that brings your yearly rents down to 40,500. Or if you don't want to do any of that, just select 11 and put in the actual amount for the year. So it could be, you're taking 36,000 for the year in rents. That gives you a gross yield on your portfolio of 5.3%, and that will change in a minute. Okay, so next thing, we now put in our allowable expenses. Now, before we do that, if you look at your yearly rents that you've taken in plus your other income, HMRC now assume now that you've gone from a 20% to a 40% taxpayer. Okay, which was normal anyway, that's what they did. But before, you could take away your finance expenses from that figure. You're no longer allowed to do that under Section 24. So now we put in your allowable expenses, which we did on the previous video, and we had a figure here, there's a prompt here, it was 2477 a month. So you can put in here 2477. It's rounded it down to 2475. Yeah, because it's going up in £5 increments. So your yearly expenses is 29,700, which now brings your property profits down to 6,300. So you're making an 18% gross margin. Okay, gross profit margin. Now, also, every individual in the UK, if you earn over £100,000, it affects your personal allowances. Now, at the moment, that figure isn't there yet, but you're going to start to get close once you start adding your mortgage interest. So it's currently still 12,570. So your adjusted income that's taxable after that, if you take your personal allowance away from that and add your property profits, it comes out at 29,730. And there's an explanation here for you to explain what's going on. Okay, so adjusted income is any income in excess of your personal allowances. So this figure here is what HMRC are going to come taxing you on. We now come to the finance expenses, where previous to Section 24 you could offset these against your profits. You can no longer do that. So we know that you've got buy-to-let mortgages that are unpaid of 474,000. If you happen to know your interest rate, brilliant. So say you've got them all on the same company, which is probably unusual. You put in there, well, currently you're on a fixed rate of say 3%. Just put in 3 there, and just click outside the box. Then it works out that you're paying £1,185 each month, okay, on mortgage payments, which is 14,220 a year. Now, if it isn't that figure, that's fine. Just press this stepper with your mouse until you get the actual figure that you were paid. You paid your lender last year, or that you're paying this year. Okay, now, supposing you come out of your fixed rate deal, and say at the moment it's 3.5%. So currently you're paying 16,590. Say you come out of a fixed deal in 2023 and the base rate is 7%. But as well as that, there will be a margin over that your new lender or your current lender will charge you once you're out. And with some mortgages, it's between 2 to 4%. So if the mortgage rate's base rate is at 7, the Bank of England base rate, and you add 4% to that, that's 11% interest. So if you change that now to 11%, your interest payments now go to 52,140. So that's going to do something to your personal allowances, and it's not going to help them. So let's assume that you've not paid that yet, and it's still 3.5%, or some of you might be on variable rates, but whatever it is, just put the figure in there, and if it, just match it up by using these steppers, because it's called a stepper, this bit, yeah, and it instantly calculates what the new figure is. In the next section, obviously, you're getting all these figures clumped together, and HMRC are rubbing their hands in glee, but you're also allowed a reduction of 20% of the lowest value of either in section E, which is property profits, or 20% off section G, which is your adjusted income, or H, which was your finance expenses. Now, common theory has it that it's 20% off your finance expenses, which is brilliant if it is, but it might not be, because depending on your own circumstances, it might be your adjusted income, or it might be your property profits. Because if you've made £10 worth of property profits, you're going to get £2 relief, because it's the lowest figure. So it's the lowest figure out of the three. In this particular case, your section 24 tax reduction will be 20% of 6,300 in box E, and box E was your rental profits. Okay, so you're going to get a reduction of 1,260 off your tax bill. So your tax band is still 20% at that rate. Okay, your tax payable is £4,686. So what's changed? Well, your tax bill before would have only been £2,628. So you're paying an extra £2,058 in income tax. Did your tax rate change? No, but you pay a higher rate than a company now. And your portfolio now has a net yield of minus 6.22%. That's not ideal, is it? Now let's assume that you then hit your higher rate because you come out your fixed rate deal, and say it's just 7%. So just change that, section H to 7. Okay, and now you're being taxed or relieved instead of on your property profits. You're still not being relieved on your finance expenses because it's not the lowest figure. That comes as quite a shocker, because it did to me, and you need to bear that in mind. But now your tax bill, although you've only made profits of 6,300, you've got a tax bill of £4,686 after you take it. Well, it's 5,946 less 1,260, which is this reduction. Okay, which gives you that figure to find. So your tax bill would have only been minus £690. So you would have got a tax refund previously, but now you're going to have to find an extra £5,276. So depending on the interest rate, your tax bill is going to go all over the place. Now, this is not a way to run a business, as you can probably agree. So it is fixable, but it takes a bit of thought process behind it. And that will be covered in our next video. So I'm going to hold all these figures here, come over to the next video for part 4, okay, and then we'll run through what might be considered a business offer for you. Okay, and I'll speak to you soon. Bye now.